Okay, I'm going to start then, guys. So welcome to the February 2021 Alban Property Meetup. So this is about knowledge sharing for property investors. And the agenda for tonight is I'm just going to go through a bit of an introduction and a welcome. Then we'll have a lending update from Sam. So we're always very lucky to have Sam on the call and think up all the tricky questions you possibly can for Sam's section, because he loves them. So that would be great. Then I've wanted someone to come along and talk about the planning system for some time, and I've struck gold with Ian. I'm not trying to build you up too much, Ian, but Ian has a fabulous website which I use myself, and he's also known as the Planning Geek. So he's absolutely the right person to have on tonight to talk about planning. And as many of you will know, that the planning system has been through some radical changes last year, and there's even more changes planned for next year. So great timing. And then just the last 10 minutes, I'll just do a review and close, and just run through any questions. Just a bit of housekeeping to begin with. The event is recorded, so it does help people if they either have to miss a part or can't attend today, then that they can watch it afterwards. If you could keep muted, just that would be really helpful. And unless, of course, you're asking a question, then you can control that yourselves. It's really good to see people's faces, so please keep your video on, and if your mobile phones can be on mute, that would be brilliant. But you're very welcome to put questions in the chat box. In fact, we encourage questions and make the evening as interactive as possible. So please just put any questions in the chat box, or preferably ask them verbally. And of course, there's no individual advice. So anything that is answered today is of a general nature. And if you need legal advice or accountancy advice, then obviously there are professionals to do that. So there's no individual advice. The objectives of the evening is for most of you will know this, but the Alban Property Meetup is usually a physical meeting. It's an informal meeting that I hold in St Albans and have done for about 7 years. Obviously with COVID that had to stop, and so we moved it to a Zoom call, and that's been really, really good, and it's very different. So it's more formal, it's more structured, but the information sharing has been or transference has been really good. And also there's been lots of changes because of COVID, and I think they're going to continue for some time as well. So it's also about keeping us as investors updated on changes to the property market, and of course Sam and our guests help us with that. And also we gain learning from industry experts and commentators, and we've had fantastic speakers on, and we've got another one tonight. Just a couple of news items. We have implemented a small charge for meetings, and this is really just to cover our costs. So it's less than a cup of coffee, but just helps with our Zoom and Meetup and the editing of the calls and things like that. We've also got a vacancy for a part-time project manager, so we're looking for somebody with experience of HMOs, single lets, maintenance, and ideally sort of service accommodation. So we are looking for somebody ideally locally, so close to St Albans. That'd be good. So if you know anybody, then please let us know. I think it'd be ideal for somebody. So it's only a part-time role. So to connect with us, we've got all the standard things that you'd expect, and with some help from Sam, we've moved our Facebook page to a group. So I think we'd set it up wrong, but so thanks for your help there, Sam. And that's all up and running. So that's a good way to access the videos of each meeting, and they're all available on our YouTube channel. I used to call it our shiny new YouTube channel, but it's not quite as new anymore. As many of you know, the main way to access us and ask questions is through the WhatsApp group, and that's really quite active. And people say time and again that that's really, really useful. And so if anyone's not on the WhatsApp group, then if you just send us a message, we'll get you put on the WhatsApp group. And we're quite often asked what we do. So in actual fact, I'm going to talk about 3 businesses tonight. So we run Alban Property, which obviously runs this meeting. So by we, I mean Lisa and myself. So Lisa's my wife. And we've got a buy-to-let portfolio. We've also got some HMOs, and a lot of our buy-to-lets we've moved into sort of service accommodation and holiday lets. We do refurbish residential properties, and really, really like doing that. Then, you know, getting and buying old properties that maybe haven't been used for some time and making them habitable. That's a home for somebody. We really like doing that. We also work with people on projects. Property can be a little bit lonely, but we do work with people on projects and really like doing that. We've also got a business called Service Short Stays. So my background is mainly software, and so the software we've got in Service Short Stays is really quite clever. So we manage our own properties for the short-term rental market. That market is almost non-existent at the moment. There is some bookings, but very little. If Lisa was to talk, she would talk about we are getting a lot of bookings for the summer. So lots of people are booking for the summer at the moment. But we have a 30-day cancellation policy. And so if people book with us, they can still cancel free of charge within 30 days. So there might be that going on. Interestingly, the prices are really holding up high. So we've got a pricing engine, so it's a dynamic pricing capability. So that looks at our competitors, looks at how busy they are, looks at their prices, and it sets our prices every single day. So our pricing has been really, really good this summer. Summer coming. We do some management of other people's other landlords' properties for the short-term market. So if that's something you're interested in, talk to lovely Lisa. Last year, I also set up a business called Brookdale Land, and that's really busy. That's grown. It was busy to start with, but it's now got really busy. So it's developing property and land, mainly in the southeast of England. So again, we're working with quite a few partners on different projects there, and we are looking for land and development opportunities moving forward. So that's something that's been quite exciting this year, but I haven't really spoken about that at all previously. Okay, that's everything. So without further ado, I'll hand over to Sam. Sam,
thanks very much. I am. Can you hear me okay?
I can hear you perfectly. Thank you, Sam.
Good. I've been having some microphone issues today, which is why I ask. Yeah, thanks ever so much. I will just quickly go and hopefully share my screen. Let's see if I can find where it is first.
Any star rolls for cats planned for this time?
Well, there is one sleeping over to my left at the moment, so I'll try and be as quiet as I possibly can to stop her from waking up. But can everyone see my screen okay?
Yeah, see it perfectly, Sam. Thank you.
Brilliant. Thanks ever so much. Well, yeah, Chris, Lisa, thanks as always for letting me come along. I always look forward to these because I actually, joking aside, I really do enjoy the questions that I get at the end. Keeps me on my toes. So yeah, get those prepped, guys. I'm happy to handle anything you throw at me. But just quickly, just to sort of run through in terms of how you can contact me in advance. So obviously traditional ways, number, email address, if you like that sort of thing. But if you're also a little bit more modern and want to come and follow me or contact me on various Social media platforms, I'm pretty proficient on Instagram, posting things pretty much daily, as well as Facebook, and as well as these guys have also got my own YouTube channel as well. Sam Norris, the Property Investors Broker, probably one of the longest names of a YouTube channel you will come across. Once I typed that in, I realized I couldn't change it afterwards, so it's pretty much stuck like that. So yeah, feel free to follow me on any of those channels. To kick off with, I just want to go through a quick agenda of what I'm going to go through today. Back with a vengeance, the mortgage market update, as well as the bridging development market update. I'm then going to go through something that I've been asked quite a lot about recently, which is actually the process of applying for and getting a bridging loan, which I thought I'd go through in a reasonable amount of detail, because I understand that for me, it's pretty normal. We probably apply for 2 bridging loans a day at the moment. So the process for me is relatively normal. For many of you, it might not be. And so I thought I would take some time out to go through that in a bit of detail. If that's something that's going to be helpful for you moving forward this year, you need to secure maybe a different type of deal than the one that you're used to, where you might use a traditional mortgage for. And then, of course, at the end, we'll run through a Q&A. So get your questions ready, see if you can catch me out. So kicking off with the mortgage market update. So not wanting to be too boring, but not much has changed since we last spoke. We had at the beginning of the year a few rumours of residential mortgages going back up to 95%. Boris was on his bandwagon talking about that. Not really materialised, to be honest with you, which I personally think is a good thing. I'm not a big fan of 95% mortgages. I think they're pretty high risk for the borrower. I think the fact that they're available puts, I think, borrowers into a false sense of security with these sorts of things. It doesn't take a huge amount of movement in the market to suddenly find yourself in negative equity, or at the very least not being able to refinance without putting some money into your deal or into your mortgage to pay it down in a few years' time. So I think they're quite dangerous. And my opinion has always been, if you can't find 10% of the property price to put down as a deposit, should you really be buying that property? I know it's not a popular school of thought, but it is what I believe. In terms of buy to let, again, we're seeing a little bit of limitation when it comes to loan to values. We've had a few pushbacks in the last couple of weeks, I should say, with a few lenders that we've applied for mortgages for, where they've been limiting the loan to value to 70% if the client hasn't owned the property for 6 months, which we haven't seen for a little while, to be honest with you. So something just to be wary of if you are following that buy, refurbish, refinance method. There might be a few limitations moving forward with regards to refinancing those pretty quickly, specifically at the lower levels we're finding. So anything sort of loans below 100,000 or so, particularly, we're finding there's a little bit less in terms of options there. We are finding as well, if I'm completely honest, valuations are starting to come in a little bit lower than we're anticipating. Obviously, as I spoke about on the last presentation, for those of you that were here last month, going through the valuation pack that we try and put together so that the underwriter can instruct the surveyor to do a true open market value of the property. If you bought a property and added value to it. But even so, we are seeing that there are valuations on the whole are coming down a little bit. We're not talking a lot. We had one that was down by £5,000 last week. The week before, we had one that was down by about £3,000 or £4,000. So not huge amounts, but just that little bit that we're seeing slowly becoming the norm. So, as a result of that, as I said last month, it's never been more important to supply those valuation packs, and these need to include good sales comparables. We submitted an application for a client 2 weeks ago, who then came back and supplied us with a valuation pack. Bearing in mind, this client has been working in property for 15 years. He supplied us with 4 sales comparables, all of which were over 6 months old, and 2 of which weren't even in the same postcode. So make sure that the sales comparables that we're using to supply to lenders are actually relevant, because otherwise it's just a complete waste of your time. So bridging and development, good grief, the last month has been busy. I would say that, and I haven't checked the figures yet, but if we look at January in terms of a comparison month on month to where we've been over the last 6 months, we're probably up around 30 to 40% in terms of inquiries for this type of finance. What that's saying to me is either my marketing's working really well, which probably isn't the case, or there's just a massive demand and increased demand for this type of finance this year, because there are so many deals out there that maybe just require a little bit more creativity with our lenders than just a standard mortgage. Or it could well be the criteria is just getting a little stricter on the mortgage side, maybe a little bit of both. Access to funding, I have to say, is really strong at the moment. We've got clients across the board in terms of varying degrees of experience, and even those that have relatively low levels of experience with various different projects, be it refurbs or conversions and even ground up developments. We are finding that lenders are trying to find a way to do deals, which is really, really, really positive. I must say, and I don't often blow my own trumpet, we get really good feedback from lenders in terms of how we package our applications, which I think does really help. Sorry, not applications, our initial proposals, which I think really helps lenders make a good, solid decision early doors. And that's something that we've just learned over the years of doing what we do. It's much better to spend some time at the beginning, really getting as much information to a lender as possible for them to make a solid decision on whether they can lend or not, and of course, on what terms. As a result of this sort of access to funding, I think lenders are looking to try and stretch the amount they can borrow a little bit more. I'm not going to go to town and say that it's a massive, massive difference, but certainly we've seen a few more looking at 75% loan to value on bridging, and certainly a few more that we've been able to eke a little bit extra out on the loan to GDV on development finance. So for those that don't necessarily speak finance, loan to GDV is a loan as a ratio of what the gross development value or the end value of your project is going to be. And it's that percentage that we work out the overall facility, that is split obviously into money that you would borrow day one and then money that you would borrow to create a development facility to draw down on to cover the cost of your works. So we are finding that those numbers are going up a little bit, particularly with some of the lenders that maybe you wouldn't expect it from. We're doing a deal with Close Brothers at the moment, who have provided us with some really fantastic terms on a ground up development deal for one of our clients, and we're looking at 65% of GDV on that. Usually they would really not want to go more than 55 to 60, so we are eking a little bit more out of them, which is great. One thing that we've seen, which is a little bit disturbing, and I had to actually call up the owner of a bridging lender recently to moan at him about this, was we're seeing more and more surveyors using a GDV valuation on bridging. So effectively what this is for the uninitiated is when a surveyor goes out and does a valuation for the finance purposes on a bridge, more often than not, they will just simply give an open market valuation, a 180-day valuation. So if you were restricted to 6 months, would that have a significant difference on the value that they give? And a 90-day, same, but for 3 months. What we've seen a couple of times recently is where a surveyor is working out the GDV. So if there's sort of some refurbishments going on, what kind of uplift that's going to give, and then effectively reducing that figure by taking off the potential cost of the funds, cost of the works, an amount that they are assuming, and not really having any sort of grounding in for a profit margin for the investor, and then whatever remains they're putting forward as a valuation. Now, my argument has been with the two surveyors that have done this recently, but that's not the open market value. The open market value is how much someone will buy the property for if you put it on the market, not the GDV minus all these random assumptions that you've made. Fortunately, one of them we didn't quite manage to win it, but we did find a way of getting the deal done. The other one, the owner of the lender, which was actually Mint Bridging on this one, Andrew, who we know pretty well, turned around and said, "Yep, I agree with you, Sam," and he stuck his hand in his own back pocket and funded the deal himself, which I thought was blooming marvelous. So just watch out for these. So it's really important to read the valuation reports when you get these back. Also noticed a few lenders adding little naughty fees on to their terms, especially when we're looking at development finance. I'm really not a fan of exit fees because I think they're unfair. Usually they're fees that are based on a GDV that doesn't exist yet, and so can actually be quite intrusive when it comes to your bottom line. We have seen a few more of these pop up. A lot of the time we will go back to lenders and ask them to remove them and try and negotiate them out. But I must admit that lenders are playing hardball a little bit more than they normally would be. So again, just something to watch out for. I think I mentioned this last month and nothing's really changed, although I have to say we've had probably about 7 inquiries to do with ground up developments over the last month, and yeah, lenders still shying away from these. They see these as the top level of risk, essentially. And what the feedback we're getting from lenders on this is, obviously with the conversion, although technically you will say, well, this could be the case for both a conversion or a ground up development, they think that the risk is higher with ground up, because if the government did decide to do a U-turn and ban construction for a period, the ground up development is the one that's most likely to be affected. And so that's the reason that they're giving for some of them shying away from it. Lenders like Octane, who we like to do quite a lot of business with because they're just pretty good at doing what they do, at the moment not lending on ground up development, which is a shame, but they're not alone. So talking of bridging loans, as I said, one thing that I have been asked about quite a lot, especially over the last, I'd say 6 weeks or so, is just to give a breakdown of what the process is for applying for a bridging loan, because it is very different, I think, to applying for a mortgage. With a mortgage, the application is pretty linear. You do one thing, then you do another thing, then you do another thing. With bridging, there's a lot of overlap and a lot of crossover, which is why not only is it important to get the right personnel on board to manage these applications in terms of brokers, solicitors, etc., but it's very important that you yourself understand this process and what is required of you, essentially. So kicking things off, this is obviously, I'm talking about the process that we run at Grand Union Finance. This is the way that we will do it. I can't speak for other brokers, of course. Now, first and foremost, we do a bit of deal analysis. We will speak to our clients first, and we will pre-check all of the figures. Essentially, we're going to ensure that the return on investment is at least between 20 and 25%. If it isn't, chances are bridging lenders are going to turn around and question that, and may even decline on that basis. So you really need to be seeing at least a return on investment of sort of 20, 25% to access most of the market. So we do those initial checks. I've got my own bridging calculator that I've put together myself on an Excel spreadsheet. Not something I share about because it looks dreadful, but it is something that we can that I work through with clients from the off. Off the back of that, if the deal actually stacks up and the return on investment is sufficient, it's at that stage that we need to create a proposal. Now, when it comes to mortgages, there are sourcing systems and there's sort of criteria lists and all this kind of stuff that brokers could use to keep the research time pretty low. When it comes to bridging, there isn't those sorts of things. Well, there is, but they're not very good at all. So a lot of the time, how we research the market for bridging is very much just what's going on upstairs, our knowledge and up-to-date knowledge of what's going on in the market, what lenders have got appetite for what, and what criteria works. We will handpick a selection of lenders that we know have the capacity and ability to do the deal, whatever it might be, and we will put together a very substantial proposal, including a background of the borrower, the type of entity that they're going to be buying in, all of their sort of assets and liabilities, their details of the site. We'll even put in a Google Maps link so they can see it. If there's any planning, we'll do a link to the planning portal as well. Very, very, very detailed. The reason that we want to do it as detailed as that is because the next stage is that the lender will pick those up and they will take what we have sent them over to their credit team. Their credit team, there's no credit report, credit searches or anything at this stage. They will check over the information that we've sent. They'll do a bit of due diligence. They'll probably Google search you, might do a sanction search or something like that. And they'll check over the figures, do their own analysis, and they will come back with a set of terms. Now, a lot of the time, I found certainly in the early part of my career, is you'd send them over a rough sketch of what's going on, and you'd have this back and forth constantly until we got to a point where they understood the deal and they were able to release terms on that basis. That's not how we want to be doing things. We want a one and done scenario. Get the details that we know that they're going to want, and get them to go to credit straight away and get terms. The quickest, because of the level of detail that we put into these, the quickest we've been able to get those terms back is 16 minutes currently. In the current climate, that is not really feasible. We usually allow 24 hours for the lenders to get those back to us. Now, assuming that the terms are feasible and our clients are happy with them, the next stage is that we will create an application pack. Now, and again, I speak from experience of getting this wrong early on in my career. Very many brokers out there, unfortunately, still do this. They'll literally get an application form, fill it out quite crudely sometimes, get the client to sign it and get it over to the underwriter. That will do only one thing. It will lead an underwriter to send a long list of requirements that are needed to do their underwriting. We want to avoid that. We know what they want in advance. We've got access to all the underwriters. We speak to them in advance and check that what we're going to send to them is what they're going to need. And we make sure that we collect all of that data and information before submitting an application. There's a very good reason that we do that. And that's because we don't want the initial underwriting to last any more than 1 to 3 days. I submitted a development finance application this morning directly to the underwriter of a new case at about 10:30, and he completed his initial underwriting by 2:30 this afternoon. I was on the phone to him then to check through a few finer points. I've gone back to the client just to check on a couple of bits, but he's already gone ahead and got quotes for the valuation, which is the next stage of this. Now, obviously, the only reason we were able to get the underwriter to have that kind of turnaround is because we provided everything that underwriter needed. But as you can see, that turnaround's pretty quick, even if it takes a little bit longer. Even if it's 3 days to get the initial underwriting done, that's a lot quicker most of the time than a mortgage will be. And as I mentioned before, this isn't a linear process. We've got lots of things moving around at the same time. As soon as that application hits, the underwriter will pretty much go to their list of surveyors to get valuation quotes. They will, once they get those back, we'll choose which one is the best, both in terms of time frame and cost. We will instruct that surveyor to contact our client to take a payment, and then contact whoever they need to get access from to gain access. Typically, at the moment, we're finding that from the day of instruction, usually we get a booking 2 to 3 days after that. So, working on our time frame from the date of application, 5 days after that, we could well be in a position where the underwriting is complete and the valuation has been conducted as well. Usually, it takes a couple of days after that for the valuation report to come back. But all in, it's not taking too much time at all if we are putting some time into getting things right. Once we get the valuation report back, usually at that stage is when we get legals instructed. Sometimes we can get lenders to instruct legals early, and that can sometimes save things. We've done a case recently where they instructed legals day one. So we submitted the application. They completed their initial underwriting. We got legals instructed and valuation instructed within 24 hours. So it can be done. But if we're working on a standard turnaround, legals will be instructed once the valuation is back. Now, if we need to do searches, 3 to 4 weeks is really what we're after. But if we can organise maybe an indemnity insurance policy or something like that, then legals can obviously take a lot less. Now, this is a really, really important point, and I always stress this a lot, is you need a really good solicitor when you're working with bridging and development. The difference really is that when you're looking at a mortgage transaction, when a lender issues an offer and sends this together with a legal pack over to your solicitor for a mortgage, it is spoon-fed. I've seen these packages. They'll list their bespoke list of requirements, and they will actually give them instructions on how to complete those inquiries and send them back. And this is why a lot of lenders use free legals with sort of South Wales call centres and stuff with trainee solicitors that are able to work through these, because they are genuinely spoon-fed. When it comes to bridging and development, the lender will pass over some of the due diligence to the solicitors to do. They will send a one-size-fits-all list of inquiries. Sometimes these can have 30, 40 points on there, and it's up to your experienced commercial solicitor to work through those and determine which are needed and which aren't, and to organise those in a timely fashion, get those back to the lenders, solicitors as quickly as possible. So as I said there, you need a good broker, almost as good as you need a good broker. Need a good solicitor almost as much as you need a good broker on these things. And of course, once the legals are done, we draw down on the loan, which obviously means we complete. Now, all in all, I find that if everything goes to plan and we get things done in the shortest possible time, there's no reason why we can't go from 1 to 8 on that list in a 2-week period. It definitely can be done. So if you're buying at auction and you've got 20 working days to complete, bridging is obviously the way to go. Even if, to be honest, you just want to get things done nice and quickly, which a lot of my clients want to do. Again, this just goes to show that if we get the process right, we can do it pretty timely. So I really hope that that's been insightful for anyone that's potentially looking to delve into a bridging loan for the first time this year, as I've seen a massive uplift in these types of inquiries. So yes, over to you guys for any questions. Hopefully that was helpful.
Yeah, that's very good, Sam, as always. I'll let somebody ask a question. So I was just going to make a statement, really, Sam, that obviously, you as a broker charge a fee for what you do, but I think for arranging bridging, but by stepping through that order, I could see the value add that a broker provides in that process. So it's not like you're just putting it into a computer and waiting for the answer. That there's you could see that there's work there, and obviously with a degree of seriousness and there's complexity there, and you could see how you could add value in making and speeding up the process by doing all that work early. So I think that was good from that perspective as well. So it was really good from this is the process thing, but you could also see the value that you as a broker add, and I thought that was really good. So
yeah, thanks, Chris.
Thank you very much. I'll just open up to the floor if anyone's got any questions for you, Sam. Otherwise, I've got a couple.
I've no doubt you do. In the meantime, I'm a bit jealous of Ian's background. I need to get one like that. That's much better than anything I've been able to put together.
He does all that very well, actually. So, so there's a few things you mentioned about valuations being lower, and I'm sure you knew I'd pick up on this. And you said about one was 5k lower and one was sort of 3 to 4k lower. Well, what was the actual valuation? Are we talking about hundreds of thousands, or are we talking like 80k? I'm just trying to get a perspective.
Yeah. No, to be honest, these have tended to be on some of the lower stuff. I mean, as you know, Chris, we don't shy away from working with anyone, whether they want to borrow 50 grand or 50 million. And we haven't quite got a 50 million at the moment, but we've certainly got several millions in some cases. And we've got, we're working with some clients. We're doing a 45, not 45. We're doing a 55 grand mortgage at the moment for one client, and that's absolutely fine. We are tending to see that these down valuations of that kind of level are happening on the lower end. And I have to admit, because usually I find that the real down valuations happen at sort of loans or values above about 1.5, 2 million, when you get to that upper level. But going off on a mini tangent, I had a really good conversation with a guy called Grant Bates for a podcast episode of mine a couple of weeks ago. And he's the associate director over at Hamptons in Islington. And he deals with high-end property. And he actually said at the moment, he thinks that the high-end level of the market, particularly in the Southeast, is really strong. It hasn't really been affected too much by the economy, hasn't really been affected massively in terms of people not being able to go to viewings, because obviously you get it's kind of a bespoke viewing arrangement there, where you're not going to get 20 people through the door to go and see a £5 million house. You're probably only going to get 2 or 3, and you'll get probably offers from 2 or 3, whereas a smaller property you'll get a ton. So he said that area of the market's actually surprisingly strong, which is really interesting. So for me, it's actually the lower end of the market that seems to be getting hit, because I think there's a lot of people entering the market, a lot of people trying to buy property, and maybe it is inflating prices a little bit above where they should be naturally. And surveyors are picking up on this. And I always say to my clients, if you can't prove that your property is worth what you want it to value at, then don't expect a surveyor to do that either. So I think there's an element of that as well. And you know, we do try and focus on that. But yeah, we did have that client, like I mentioned in the presentation, that gave us 4 sales comparables and none of them were any good. And I really, bearing in mind it was one of Engin's clients, not mine, I wanted just to say to Engin, please go back to him and tell him he's an idiot, please. He should know better. He really should. He's an amazing investor.
So I know from my own experience that sometimes they're just not there, you know, that nothing similar.
Yeah, but that's when you need to delve a bit deeper, you know, and look at, you know, price per square foot, and you know, and various other you know, bits of information. I feel like a bit of a broken record when I say this. I say to people all the time, being a property investor is one of the hardest things you can do. If you think that this is an easy thing, then you're wrong and you will fail. So I have to be quite blunt with a lot of my clients. You know, when they say I can't be bothered to do a valuation pack, I'm like, well, just give up. Just give up. You know, you've spent all this time trying to find a property. At least do your due diligence. There's a lot of people look at the front end of a deal and they don't look at the back end with the same level of due diligence as they do when they're buying a property. And for me, that's where the deal is made. If you end up with something that cash flows and works and everything like that, then that's where the deal is, because that's what you're going to have for 20 or 30 years. You know, and this is why I get hung up a lot on talking about the cost of bridging finance and that kind of stuff on the front end. If on the back end it all works out and you've got a nice cash flowing asset and you get your money out, who cares how much the bridging finance costs? So it's all about the asset at the end. And that's where I think a lot more due diligence should go into these deals from the outset when lenders are doing their deal analysis. Sorry, not lenders, when investors are doing their deal analysis.
It's very difficult to overdo the due diligence, really, isn't it? So normally more rather than less. Yeah. I've got one other quick question, but Roger, have you got a question?
Just a quickie.
Hi, Roger.
Hasn't mentioned interest rates at all.
Do you know the reason I don't do that is because it usually bores people to tears when I talk about interest rates. And a lot of the time, when I first started doing presentations, one of the big bit of feedback I had was I would spend a lot of time just basically copying and pasting all the new rates that different lenders had come up with over the course of the month. And effectively, most of the time, it wasn't going to be particularly relevant to the vast majority of the people watching. So I try and steer away from that. And yeah, if you've got insomnia, one of the best things to do is to read a lender's rate sheet. That will get you to sleep. But on the whole, to be honest with you, Roger, another thing is there hasn't really been a massive amount of change, to be honest with you. I've seen Kent Reliance sending me emails once a day for about 3 weeks or 4 weeks telling me that they've got a 3.04% interest rate. I want to call Adrian, their sales manager, and say, yeah, I know. You don't have to keep telling me. and that's the same with a lot of lenders, unfortunately, at the moment. That's why I kicked off the mortgage update with nothing much has really changed. So that's the same with interest rates, really.
Okay. Thanks, Sam.
No worries at all.
That's a good question, though, Roger. One quick question from me, which in less than a minute, Sam. I was talking to someone today, and they mentioned the fact that if you're on furlough, the furlough income isn't being counted by lenders, and I hadn't heard that before. Is that right? Because that's going to really impact people that aren't working from no fault of their own, sort of moving.
Yeah, it's lender to lender, so it's case by case. If you've got a return to work date, usually that's absolutely fine. Obviously, I know a lot of people won't have that. If you are only receiving the 80%, that's when it's going to be a bit more damaging. But in honesty, this tends to be more in the residential market rather than the sort of the buy-to-let and investment market. As we know, those lenders can be a lot more flexible. But no, you're absolutely right. A lot of lenders are doing a lot more due diligence and underwriting on this, and making decisions based on their comfort level. So if you have been on furlough, be wary of this. Speak to your broker and make them aware. Be really transparent with what your current situation is. And the same goes, as we've said previously, Chris, to if you're on payment holidays or you've received bounce back loans or Sybil's loans, anything like that. be completely transparent, especially if you're using a broker, because look, we can only do the job based on the information that we have. We're on the same team effectively. So the more information you give us, the better placed we are to be able to find you the right deal first time around.
Yeah, brilliant. Thanks for that, Sam.
No problem at all.
It's always really informative. I love the bridging process. You've kept us sane through all this and updated, and for that you have our thanks.
You keep me sane too. Stops me from sitting all night just doing deal analysis and application forms.
That's good. That's good to hear. But thank you, Sam.
No problem.